Good morning, everyone, and thank you for joining us for our webinar this morning. Before we begin, we'd like to cover a few housekeeping items. To ask questions, please use the Q&A widget on your screen. We will try to address questions throughout the webinar. Otherwise, we will try to get back to you via email. For those seeking CLE credit today, please download the affirmation form and the evaluation form in your resources widget on the screen. We will announce the CLA code once during the middle of the presentation. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these via email after the webinar. My name is Phyllis Korf. I am a partner in the capital markets practice at Mayer Brown, and I'm happy to be joined today by Jeff Hoffmeister, co-head of Morgan Stanley's U.S. Technology Investment Banking Group, Ashley McNeil, Head of Technology Equity Capital Markets Americas at Morgan Stanley, Genevieve Kinney, Vice President of Technology Equity Capital Markets at Morgan Stanley, Carolyn Saki, Chief Operating Officer of Capital Markets at the New York Stock Exchange, and by my partner, Anna Pinedo, who is co-leader of the Capital Markets practice at Mayer Brown. We will start with some background and foundational information from Morgan Stanley, and then move on to our panel discussion. I will now turn it over to Ashley McNeil.
Great, thank you so much. Really appreciate everyone taking the time. We just wanted to level set sort of why are direct listings a topic that really started to percolate, call it fall of last year, but obviously had some momentum from a year ago. And we wanted to lay the groundwork of why it's become such a discussion with corporates and where we sort of see this going. So a direct listing, as most of you know, is where a company elects not to go through the formal S-1 process and instead decides to file a form of an S-1 registration statement with the SEC, which then facilitates basically an opening trading day. And it provides for an opening pre-auction of a direct listing. And there is no formal book build process, there is no filing range, there is no lockup. All investors, the key premise for the direct listing is that all investors have, all shareholders and all potential new investors have equal access, in theory, to participating in that opening trade and in the stock in subsequent days. This concept was originally created for Spotify. Barry, the CFO of Spotify, felt that the IPO process was quote unquote rigged, and he felt that it didn't offer as full a transparency process as could be done through normal course trading. And so he sort of embarked on this journey with us to figure out how do I provide full transparency, remove all lockups, allow free access for everyone, and still get listed. The fun little fact that people tend to overlook, and Carolyn can definitely talk about this, is direct listings in theory have been around for years. They were generally for things for spin-outs or for companies basically coming out of bankruptcy that were choosing then to relist. So this was what was innovative about this product, and why this product has become such a hot topic, is that now we have companies that never were in the public domain that should have no problem raising primary or secondary capital if they want, deciding to go this route. So obviously we've had an NF2, Spotify and Slack. I think if you asked us before Corona, how many we were going to have. We were estimating there was probably 4 to 5. We think there's probably 3 now. I think the ones that have decided to hold off or maybe pursue a different route have to do with specifics to their company and not to the actual product. The time is right for direct listings. I'm just going to put all of this slide up right up front. Look, I think the big genesis of why these have become a hot topic for corporates is because companies are going public much later in their life cycle. They're way less capital intensive than they used to be, particularly with this new realm of software companies coming up. The private markets have been far more efficient and liquid than they've ever been. And the trade-ups from day one, while the public investor side wants that trade up, I think the pre-existing shareholders who maybe have sold in the IPO don't love it. But to be honest, the buy side isn't in love with a 50-60% trade up on IPO either, because then they're forced to sell because the stock goes through their price targets. So the direct listing is a product that helps eliminate the volatility of that opening trade, helps facilitate a private market. So if you already have a fairly liquid private market, it further facilitates that. And if you don't need primary capital, which as of right now, you cannot raise primary capital in a direct listing, this is the route you go. And this whole product came about because, and you'll see that I have a few slides on this, so bear with me as we get a little bit preachy. But this product really came about because all of those factors I just described, the volatility, the lack of access, the buy side not liking the 50% pop because they get 100,000 shares on the IPO, they need a position size of 2 million shares and they can't get it because the stock price has now gotten away from them. All of this really comes down to the fact that liquidity has really disappeared from the IPO process. And, our team put together some fun stats that help sort of justify and explain why that liquidity, proving that liquidity has disappeared, and the implications of that liquidity disappearing. So, the average IPO in 2002, they were IPOing almost 30% of their TSOs. Last year, that average IPO was 17% of their TSO. So companies are IPOing less of their TSO, and therefore IPOs size-wise are just shrinking. And it's helpful to keep in mind that investors, when they look at position sizes, they're looking at position sizes relative to their portfolio, but also relative to TSO. So you may say, well, yeah, but IPOs are getting bigger, so the dollar amount being raised is consistent. That's not what the investors are focused on. The investors are focused on how much of the company is floating. How liquid will this be when I need to trade in and out of it?
Ashley, sorry, it's Phyllis. Just for those of us who are not as familiar with the jargon, could you tell us what TSO is?
Sure. Sorry. Apologies. And yes, please interrupt if I'm using any jargon that needs explanation. So total shares outstanding. So in an average company, in 2002, they were IPOing 30% of their total shares outstanding. So the float was 30% of the company. Now it's 17%, or at least in 2019, and that number is getting smaller by the minute. To put it in context, Zoom, which was a very popular IPO and is becoming more popular by the minute, when it IPO'd 9% of its total shares outstanding. So that's a really small float for the total size of the actual company. And as an investor, that is one of my considerations of how much I can own of a company, is how much of its shares outstanding are actually available for purchase for me. The second thing that has been a big trend that we've noticed is that secondary monetization has decreased. So in an average IPO in, call it 2007, you saw about 64% of the deals have a secondary component. And on average, if you were IPOing $100 million, 10 of that was secondary. That has now gone to only 30% of our IPOs have a secondary component, And of that, the ones that do, on average, it's only 6%. So that $100 million IPO, it's now only $6 million that would be secondary. So why does that matter? Well, that matters because if you care about volatility and liquidity, the ability to have any transparency into what that secondary, when those secondary shares are going to come free is diminished because there's less of a declaration by those shareholders at the time of IPO. And it also plays into the deal size shrinking. Finally, we're seeing that so all of this is happening, but at the same time, we're seeing the total deals, IPO volumes go up massively. So deal size are shrinking, liquidity for individual names are shrinking, but I have more opportunities to invest than I have ever had. I have more names, I have more things I have to look at, and frankly, I have bigger dollars that I have to put to work. So as an investor, that is sort of a scary dynamic. And as a corporate, I'm now having to deal with the fact that my $2 billion company is now $5 billion. And so every decision I make about how much money I'm raising dramatically impacts my ultimate market cap. And then all of this, while all of that is happening, so the actual structure of the IPO product has fundamentally undergone this sort of liquidity volume change. We have the assets under management that is chasing these IPOs, this asset class, almost more than doubling. So look, it's a proxy, but if you look at total AUM for investors in 2004, it was 14. In 2019, it's 36 trillion. Now, there's lots of arguments of, yeah, but the value of those funds has gone up. It's not actually more dollars going in. Well, if you peel back the onion a bit more and go into the next layer, no, it's actual more dollars going into the public system of chasing the IPO product. Funds flows have been positive. We'll see what this month is. But funds flow have been positive for the last 10 years on average, particularly in growth and particularly in technology. So punchline is smaller IPOs with less ability to buy, less ability to buy in these IPOs and more structure around these IPOs. That is put against more money needing to chase these IPOs. Which is creating this liquidity problem, which is what has basically created the rise of the direct listing product. This slide is meant to just show how tech IPO volumes have remained sort of modest, even though deal size have gone up. So again, to the point earlier, you've got bigger deal sizes, but your actual amount that you can participate in as an investor has remained fairly consistent. And then this is peeling back the onion a little bit more on that 36 trillion number that I told you. We've sort of broke it out by some of the highest quality mutual funds that we see participate in our IPOs. Again, you know, to be balanced, some of this is assets just appreciating over the time period, but part of this is new dollars coming in. So if I am Will Danoff at Fidelity Contra Fund, which is the second fund down there, in 2004, I only had to worry about deploying $44 billion into the IPO product. Now I have to deploy $114 billion. That's a lot, and there's not a lot of options. And all of a sudden, the $100 million IPO really doesn't move the needle for me. I need the $5 billion IPO, but in that $5 billion IPO, I need to be $1 billion or $500 million. I need. It's just the sheer quantum of size that Will, for example, needs to chase. Create this dynamic of a lack of liquidity, because once he gets in, he doesn't want to get out. And then if I'm, you know, BlackRock or T. Rowe trying to get in too, I can't because Fido's now in. So all of this is meant to sort of help support the notion that liquidity, lack of liquidity in the IPO product is really what started driving the direct listing product. And that is why we don't think the direct listing product is going away anytime soon until we solve sort of the liquidity issue of the IPOs. Not to keep hammering the same point, but this is meant to sort of continue to make the same point. Here, what this is saying is, look, you get these big trade-ups, you get the volatility in the IPO product because you are doing smaller and smaller IPOs. So this is trying to put together basically the funneling of the thesis, which is if I have a 750 or $1 billion IPO, I allocate the top 40% to 10 investors. That means I only have 300 million to go. So 300 million goes to the top 10 investors. That means I only have 450 million for everybody else. These books on average can have 500 to 1,500 investors. And then the top allocation for those top allocations, so in this example, 60 million is the top allocation. That top allocation actually isn't just going to Will Danoff in my prior example. That top allocation within a Fidelity or a BlackRock or T. Rowe gets split up 4 to 8 different ways. And so as Will Danoff, if I participate in this IPO, I don't get a $60 million allocation. I get a $12 million allocation, which, again, to my point earlier, is a drop in the bucket relative to its fund size. So there is, while the press would have the perception that the direct listing is a product that is hated by the buy side, I think we're trying to help present an argument that there's actually a lot of buy-siders who like the direct listing product because the IPO product, for all intents and purposes for them, is broken. And for corporate, it is broken too because this volatility that we've outlined is anticipated to persist. So in that, we wanted to throw up some stats for you guys so you can compare and contrast jumbo IPOs to the Slack and Spotify direct listings. Again, it's sort of an N of 2 here, so you have to be careful pulling out too many conclusions. But as you see, on average, number of days to turn over float, substantially less than your average IPO. Your volume at the open, obviously significantly more. It says FDSO, that's fully distributed shares outstanding, for what it's worth. But the point is essentially that the direct listings facilitates a lower volatility and much higher liquidity for investors. And why do we care about that? Well, we care about that to the point I was trying to make earlier, which is if you look at Slack versus Zoom, it is the ability of the shareholders to make a declaration of the investments they want to participate in. So T. Rowe Price, at the top of Zoom there, they could never have accumulated that size of position in an average IPO. And so they may be regretting that decision, but at the time, they had decided that Slack was a company they wanted to own, and they were able to get a position size in a very short time period, in a matter of weeks, relative to CapRe, who it took months to get sort of the same level of position size in Zoom, which was a traditional IPO. So now that I've sort of laid out the case of why people like direct listings, both from the investor side and the corporate side, I just want to take a minute to go through why does a corporate decide to go down the direct listing path. The biggest question is, do you have a need for primary capital or not? If you do, then you need to go IPO. As of now, there is no mechanism in place to raise primary capital in an IPO, and by primary capital I mean no one's selling in the IPO. It's the company raising funds. That may be changed. I think that everyone's working really hard to try to figure out a way to facilitate that, but as of now, that is the construct. 2, company profile. So it used to be that we felt like you had to have like a big consumer name so people would know. So Spotify, it's really easy. You're on everyone's phone. People know who you are. But Slack's success, I think, has proven that it's really more about the company, the business, the path to profitability, and sort of the key metrics that any other investor would look at if you were IPOing. Shareholder composition, you can do a direct listing if you only have one major shareholder. There are certain parameters and things you have to put into place, but you do need shareholders who are willing to sort of engage in the direct listing process, i.e. they have to be willing to sell. If you don't have any sellers on day one, you don't have any buyers, de facto you don't have a listing. And then, liquidity opportunity we've spoken about, transparent we've talked about. Level of comfort, I think this is one that gets overlooked by people. You have to have a management team and a board that is willing to step back and believe that markets are efficient. That sounds really common sense, but to be honest, that's been one of the harder challenges for a lot of the corporates that we've talked to. In an IPO, you have the guardrails of a price, a filing range, of a size of your IPO. Basically, you have everything laid out of what's going to be on the sell side of the curve, and so you just have to solve for the demand side, the investor side. In a direct listing, you have to solve both those curves. You have to figure out who's selling where, when, how, and you have to figure out who's buying where, when, and how. And a lot of corporates and boards, I think, that is one issue they really wrestle with. You fundamentally have to believe that markets are efficient, and markets are and that markets will be liquid. This page is again, just to level set, is meant to outline that there is a lot of, everything is very similar between an IPO and a direct listing. There's a few different work streams that you have to do, but for the most part, the overlap is very, very similar. And so I'm sure we'll get into it in the panel, but the bottom line is that there isn't that much extra or different work than you would normally do for an IPO process. There are a few nuances around investor education and around, stabilization agent versus advisor to the DMM, but essentially, for all intents and purposes, it's a very similar process. In the interest of time, I'm not going to go through best practices because I think those are something that we can drill into in the panel. But I do think that it's important that we hit on this slide, which is, look, the next direct listing is not going to look like the last two. Each time we're doing these direct listings, we're finding both the investor base gets smarter, but so do the corporate. So things that, this product will continue to evolve and change. I think there's thoughts about, do we do some form of lockup in a direct listing, which sounds like an oxymoron. But if you think about Slack and where some of the pushback was on Slack, it's that the buy side dramatically underestimated the liquidity coming out there. Will the private markets become much more fluid? Will there be a more sincere effort to create an OTC for a name? Will companies start listing earlier because this product avails itself to it? Will we start to understand the trading dynamic better? And how will investors respond? Because they're also learning how to deal with this product for the first time. And I'd say the press definitely wants to paint a picture that the last two, haven't been that successful for the buy side. I think that I would, beg to differ, but I do think that there's definitely some buy-siders who are figuring out, learning, and some investors who are figuring out, learning, feeling their way through this product and still have a lot to learn. So what's next? We definitely expect additional direct listings this year, as I mentioned. Do I think the number decreases with the recent market volatility? I do. I think that presenting to a board a new product that only has, examples of two is a lot more daunting in times of volatility. So I expect that that there will be some direct listings this year. I think that, had you asked me in January, I would have said, 5 to 6. Now I'm probably like 3 to 5. But I do think there'll be lots of direct listings in years to come. And hopefully that was a good overview for everyone, and happy to take questions.
Yeah, thank you very much, Ashley. Those were terrific insights. Before we move on to our panel discussion, I'm going to read the CLE code twice. It's 03, M as in Mayor, B as in Brown, 1, 2, N as in Nancy, P as in Peter. One more time. 03, M as in Mayor, B as in Brown, 1, 2, N as in Nancy, P as in Peter. Please include this code on your affirmation form. Both the affirmation form and the evaluation form are in your resources widget on the screen. Okay, so let's get to a bit of a discussion now. First of all, I'd like to ask someone from the Morgan Stanley team, Ashley, maybe you, is the interest in direct listings principally from tech companies, or are you seeing others? And then, Carolyn, I'd like to hear what you have to say about that from the New York Stock Exchange side.
Yeah, Carolyn probably has more insight than I do on this because I am focused on tech. That being said,
right.
I also lead all of the charge on our crossover names. So what I mean by that is like tech, consumer tech, healthcare tech, financial technology companies. And I would say that more often than not, those are actually the companies that it appeals to. It started in tech because tech had growth and momentum, and so getting investors was never a problem. Figuring out how to allocate to the investors was the problem. But now I think we're starting to see this product evolve and mature into other areas. But Carolyn probably has a better perspective.
Mm-hmm. I agree with Ashley. It definitely started out in tech, and what's interesting is we've had conversations with every single industry on this topic. As you can imagine, when something new comes out, every board, every management team wants to learn more about it. And as the conversations continue, people see some of the limitations on it. You can't raise primary capital, et cetera. And then they realize that the traditional IPO is better for them. But we are continuing to see interest from all sectors. I think tech, is the most kind of innovative and aggressive there. But I think we will be seeing more outside of tech in the near future.
Interesting. Is the interest that you're seeing primarily from VC or PE-backed companies? Carolyn, you can start, and then Ashley, you can add a word.
Sure, and I definitely think that it is principally from those from the VC firms because they're the ones that usually see that pop on that first day in tech land and start to consider whether or not that's what it is that they're looking for. They're also realize very clearly that their offerings on the IPO side is such a limited float, a limited amount that they're selling. It's just the first of many transactions, so they're just very focused on getting companies public. So I think that's why they're the most interested in it. On the private equity side, there's interest in it for sure, but they want a little bit more control over things like who their new investors are going to be, so they've been holding back a little bit. What have you seen, Ashley?
Yeah, I think that the VC community has definitely embraced this product. I'd say the sponsor world is and the difference I'm delineating is VC is growth and investing in early stage, PE later stage, and a more complete portfolio of companies, so growth assets and some more stable deleveraging, cash flowing assets. PE, I'd say, is more skeptical of the product, and then founders and co-founders, it's a mixed bag. It really depends. Like if they need the money, then an IPO is they don't even look at the direct listing. But I think for some of the co-founders that want to retain control, it's an option.
Right, Ashley. What would you regard as the ideal profile of a candidate for a direct listing?
Yeah, I touched on this. In the presentation briefly, but first of all, the product's evolving, so there's no such thing as an ideal candidate. What has worked so far are companies that don't need primary capital. In case we did say it, that companies that have a product or a name or something that an average consumer can relate to or knows of. So that's not a must-have. I just think that's a big benefit. And then finally, you need a shareholder base that's somewhat dynamic. And what I mean by that is you don't want it to be too concentrated. You want it to be big enough, long enough from a numbers perspective that you're not relying on just one or two people to sort of show up to the party, and that you have a wide variety of sort of shareholders to all sell at various price points. A direct listing is creating two curves, a supply curve and demand curve, and the ideal candidate in a direct listing needs to be able to have visibility into that supply curve. So you need shareholders or investors before you're public that will accept the product, buy into the product, and be active participants in the product. It's much less of a passive product for private company shareholders. And then the final thing is scale. We used to say you had to be like, 10 billion plus market cap company to do it. I think that's fallen away now. I think we feel like this will span the scale, but I do think that smaller companies will have a lot harder time doing a direct listing.
Yeah. Anna, can you give us an overview of the SEC filing process and, a little bit about the timeline?
Sure. So Ashley touched on some of these topics, and I'm going to just go into a little bit more detail on the SEC requirements and how direct listings work. So to Ashley's point earlier, direct listings have been around for quite a long time in the sense that companies before the NYSE rules changed could, if they so chose, do a Form 10 registration statement, so a registration statement that's filed under the Exchange Act, or for a foreign issuer, a Form 20F. Serves the same purpose as the Form 10, again, a registration statement filed under the Exchange Act, and list a class of their securities provided that they meet the listing requirements on the exchange. So going back quite a number of years, we saw a few direct listings outside of the spinoff and the bankruptcy context, which Ashley alluded to. We saw a few direct listings of biotech companies, other life sciences companies, and companies in a handful of industries that, for any number of reasons, had not been able to or chose not to go the route of a traditional IPO and sought to list a class of their securities on an exchange without doing a capital raise, and then subsequently attempt to do a capital raise, whether in the form of a PIPE transaction or another a follow-on transaction. Of course, all of this changed with the first direct listing, and of course before that the NYSE paved the way by changing the direct listing standards. And I'm not going to go through those. Carolyn will do a much better job than will I explaining the NYSE direct listing standards. What I will talk about is that as part of those listing standards that the NYSE adopted, the SEC required the filing of a registration statement under the 33 Act. So no longer in this context do we see the Form 10 registration statement that we used to see associated with direct listings and that we still see associated with spinoffs. But in this particular context, for a company that has not had a public security listed on an exchange, the issuer has to have declared effective a registration statement that covers the resale of securities that are held by security holders. And that registration statement will take the form of an S1 for domestic issuers and then an F1 for foreign private issuers. And of course, as usual, an issuer would file an 8A together with that. So we often get asked whether there's less work, and I'm sure the Morgan Stanley team gets asked the same questions, whether the process is significantly different, and Ashley touched on this a little bit. But in this context, it's a resale registration statement on a long-form registration statement. So an S1, it's the first time that the company is going to be describing its business, even if the company itself is not offering securities. So the disclosures and the disclosure requirements under Regulation SK for that resale registration statement are going to be virtually identical to the disclosure requirements that would be applicable in the case of your typical IPO registration statement. The only things that will be a little different and that bear mentioning is that in your typical IPO registration statement, there will be a price range. And setting that price range and identifying that price range in the prospectus will allow the issuer to engage during the roadshow process and will allow for book building. In this context, there'll be some indicative pricing information. There will also be disclosure relating to the selling stockholders, and there will be some special disclosure in the plan of distribution section that would replace the usual underwriting section in the registration statement, and the plan of distribution section will describe how the selling stockholders could effect transactions under that resale registration statement, and that might include in dark pools, on exchange transactions, in blocks, and so on. So it could be a very broad plan of distribution. It'll also disclose the extent to which the company has a commitment to keep that resale registration statement up and effective for some particular period of time. So if you put all that in context, it's the same disclosure. You're going through the same type of drafting process, albeit maybe with different people around the table. You're going through a very careful diligence process because the company and the signatories to the registration statement, the directors, will have liability in respect of the information that's included or that's omitted from the registration statement. The process of putting together the financial statements will be very similar. So companies should not expect that the production of the registration statement is going to be any less rigorous or any less demanding. Similarly, the SEC review process is going to be the same as the process that the SEC staff would undertake when it's reviewing an IPO registration statement. So similar timing in terms of the first 28 to 30 days for a set of comments, the back and forth with members of the SEC's staff and the Division of Corporation Finance and the accounting group on the disclosures that are contained and any accounting issues that arise in the context of the registration statement. So all that as well should be expected to be somewhat similar. Of course, during the SEC review process, there might be a little bit more of a focus on some of the risk factor disclosure with respect to the price at which the shares are expected to trade, the liquidity of the shares, and things relating to or particular to the direct listing. And then once the registration statement is declared effective, unlike the traditional process where you would have the registration statement declared effective on pricing day and the underwriting agreement would get sold, the stock would trade. In this case, the registration statement would be declared effective and there might be a period of time before the stock begins to trade. And I'm sure Carolyn can tell us a little bit more about that timing and some of the thought process relating to that timing. Again, for issuers thinking about this, So once you have a registration statement filed under the Securities Act that's declared effective, the issuer becomes subject to Exchange Act reporting requirements. The issuer also becomes subject to the various corporate governance requirements stemming from Sarbanes-Oxley, the Dodd-Frank Act, and of course the NYSE's own corporate governance requirements for listed companies. So companies that are thinking about this should factor in that the same type of preparation, the IPO preparedness that they would go through in a traditional IPO process is still relevant and still incredibly important. So I want to touch on a handful of other points just to reiterate some of the things that Ashley noted. In this case, there is no lockup restriction, or generally there is no lockup restriction. So since we have no underwriter, the company, the directors, the officers, the existing stockholders are not bound by a contractual agreement with the underwriters to refrain from selling their stock for a period of time. However, it is possible for the company to agree with certain holders that they are going to lock up their shares for a period of time. So that is more individual to each company. And here again, it's important to keep in mind that a company that's contemplating a direct listing should think about all of the agreements that it may have entered into with various different classes of security holders. So as was noted earlier, companies are staying private much longer. They're financing their activities through successive rounds of private placements with institutional investors. Oftentimes in each of those rounds, there are registration rights agreements that are negotiated. There are other investors' rights agreements that are negotiated. There may be provisions that have been written to kick in specifically when a qualifying IPO is undertaken. And in most documents going back, that go back a few years, that qualifying IPO definition or the various triggers to having, let's say, a preferred security or a convertible security that's not preferred, convert may all tie to a particular definition. So there may be quite a bit of housekeeping to do in advance by companies that are contemplating a direct listing, just so that they understand what contractual arrangements exist with stockholders from each of their series and how those might affect who gets included in the resale registration statement, as well as how that might affect lockups. So, and just as there is no specific lockup required, many of the rules that we kind of take for granted in the context of an IPO are a little different, and there may not be an intuitive answer in the context of a direct listing. So, for example, we're all familiar with the communications rules that relate to an initial public offering. The SEC has a framework of restrictions on IPO-related communications. And there's a quiet period that follows the completion of an IPO. In this case, there's no traditional IPO quiet period. So that may affect the thinking related to announcements. Likewise, since there is no underwriter, there is no traditional stabilization process around a direct listing. Nonetheless, offering financial advisors and investment banks might still be quite interested in understanding whether, for Reg M purposes, a direct listing would constitute a distribution. And here, there's some guidance to be considered from a no action letter that was obtained in connection with the first listing relating to whether what the applicable restricted period is around a direct listing. We can also think about that in the context of the role of the financial advisors. They're focusing as advisors, so they're not underwriters. They're focusing in an advisory capacity. So issuers need to understand that they're not engaging in the typical book building process. They can't take indications of interest or orders when they're doing their educational meetings. As a result, the company's management is not really going to have influence necessarily over who gets allocated stock because the stock is being offered by selling stockholders in the market. Also to be considered is that an issuer may not have the same type of interaction with the research personnel at the various investment banks that they might have in the context of a traditional IPO. So those meetings and that dialogue may be a little different. Finally, in the context of existing security holders, whether security holders are included in that resale registration statement or not, a direct listing obviously has advantages for all stockholders of the company in the sense that there's now going to be a quoted or traded price. So even if a stockholder is not actually selling, they will have a mark for their securities. They'll be able to value at market the securities of the company. And ultimately, with the company having become a reporting company, it will be much, much easier to affect transactions under Rule 144. Lastly, in terms of whether this is more sort of a theoretical question, we talked about there not being an underwriter in the sense that the financial advisors are acting solely as financial advisors, but is there a statutory underwriter? So in the old style direct listings or in a spin-off context where a Form 10 registration statement is used, it's pretty clear that there is no statutory underwriter. But here, some of those questions may be a little less clear or a little more ambiguous in the sense that clearly the SEC wanted there to be a Securities Act registration statement. One could infer that that's for purposes of ensuring that there's Securities Act liability. So is it possible that participants in the process would be considered statutory underwriters or distribution participants? I think that remains an interesting question. Likewise, there now have been a couple of interesting cases that raise the question as to whether a direct listing challenges the Securities Act notion of being able to trace whether securities that have been purchased by investors were purchased pursuant to a registration statement. And that's relevant for many purposes in terms of asserting claims for liability. So Phyllis, that's just a quick overview of a number of the legal documentation issues that folks might think about when they're contemplating a direct listing, in addition, of course, to all of the business factors that were discussed earlier.
Yeah, thank you, Anna. And I think you touched on this, and Ashley touched on this as well. But we've had a comment and a question from someone in the audience who says direct listings are not really new. They've been getting done for years. Isn't it getting more attention now as companies have increasingly resisted the underpricing that's associated with IPOs. Ashley, would you like to respond to that?
Sure. As a former syndicate captain, and what that is for people who don't know is my role used to be basically the auctioneer for an IPO. So you're trying to create the auction and create the price tension with investors. I obviously take great offense to that rhetoric, but I understand where it comes from. And that is why the bulk of the presentation that I went through really focused on the evolution of the IPO and how it's resulted in the direct listing, in the sense that finding a clearing price for an IPO, particularly in tech and particularly for high growth assets, is incredibly challenging, because you have two things you can work with in an IPO. You have price and size. And in an IPO, size is being constrained, and to my points earlier, it's actually being reduced. So as you reduce size of an IPO and de facto supply of an IPO, you're gonna create an unevenness in the demand, and that demand's never going to be satiated at the time of the IPO. And as a result, you're going to keep having these sort of pop-ups. The way you solve that pop-up in an IPO, which is what I say to companies all the time, is do a bigger IPO. You don't like it trading up 30%, then do more size, and it won't trade up 30%, perversely, because you're satiating that demand right off the bat. The direct listing, I think that I've had numerous conversations with the buy side, and I think they're gonna start being much more prudent about how they approach this product, and you're going to start seeing what they affectionately call the direct listing discount, which is both an IPO and a direct listing are risk transferring. You're transferring ownership from one person or one entity to another. And in an IPO, it's common practice to have this quote-unquote IPO discount, i.e., you want me to take a risk, you want to transfer your ownership of this company to me, I need it at a discount because I am taking a bet on this company that has yet to be a public company. In a direct listing, we actually haven't seen that yet, but we're going to start, I suspect, seeing that, because we're going to start seeing people, investors, buy-siders saying, wait a second, you're still just transferring the risk of ownership of this company from you to me. I still don't know how this company is going to look as a public company. I need a bit of a discount. And so I think it's just too soon to say that a direct listing doesn't end up in sort of the same situation as an IPO with this quote unquote IPO pop or IPO discount or whatever you want to phrase it.
Okay. Carolyn, maybe you can address for us how direct listings fit in with the full suite of products and methods available for companies to be listed, including IPOs, SPACs, and other kinds of transactions?
Absolutely. I mean, we look at direct listings as just another option for companies to go public, because there aren't as many public companies today as there were even a decade ago. So we would like to see more companies take some sort of action to enter the public markets. If you look last year, 20% of the IPOs during the year actually were SPACs. This year, it's probably closer to 34-35%, and we expect this trend to continue. So whether you're looking at your management team and you're looking at entering public markets, and you have the option of an IPO, you have the option of combining with a publicly traded SPAC, or you have the option of a direct listing, I think it's great to have those options. And management teams are evaluating all of them when they're looking into it, and they're finding the benefits and some of the disadvantages of them and going in one direction or the other. But it's great for the management teams to have these types of options nowadays.
Yeah. Can you give us an overview of your standards for a direct listing, or how a direct listing works from your perspective?
In terms of direct listings from an operating perspective on like day one on the actual trading?
Sure.
Yeah, so that's the fun part, and so would love to talk about it, because the beginning of the process is very similar, as has already been mentioned, to an IPO. We walked through all of the documentation that's required. It certainly is not an easier path in any way, shape, or form. In terms of some of the standards that you need to qualify to list on the New York Stock Exchange. Think of yourself as, you are a new company listing on the NYSE, again, whether it's an IPO or whether it's a direct listing. Standards apply in terms of financial standards, corporate governance standards, and then also distribution standards. The distribution standards are slightly different because there's no underwriter there. So we need some sort of actual demonstration that there's going to be a public float. So sometimes if you see a company as large as Spotify or Slack and you expect them to come on the market, it's very easy to say, yes, absolutely there'll be enough of public float. But when we look at it, we need to look at it from the SEC's perspective and sort of from an audit perspective, like how do we actually show that there will be enough of public float out there. So we're looking at, in cases like for the direct listing, we need a third-party valuation that's demonstrating that public float of at least $250 million, or looking at a sustained trading in a private placement market, so that there's something all the way already out there that's demonstrating that there's liquidity in the marketplace. Very similar to standards with any kind of new listing. There's a minimum stock price of $4, 400 round lot holders or holders of 100 shares or more, and 1.1 million public shares out there. So that already, from an NYSE perspective, sort of limits the types of companies that can be on. These tend to be the traditional IPO size. Our financial standards, by the way, for a traditional IPO is about 200 million of equity market cap on the night of pricing. So they are a little bit larger than that because of the demonstration of public float that we require. But the process after sort of the qualification through the exchange and through the registration statement filing is a little bit different as well. And again, as I mentioned, this is kind of where the fun part comes in. One of the things after the company has filed a registration statement, and typically it's confidential at first, there will eventually be a public filing, and then instead of conducting a roadshow, the company will have the opportunity to conduct an investor day. And this investor day is different because if you think about a roadshow, you're conducting a series of one-on-one meetings behind closed doors, whereas in the case of an investor day, it's really open to absolutely everybody, and every investor out there has the opportunity of learning at the same time as everyone else about the company in more detail. So it's a really, really transparent process, and this is something that the earlier founders really were very, very focused on in terms of this being a very democratic and open process. On auction day, on day one, is where the fun starts. But with us at the exchange, there's a little bit of entertainment the night before. So the night before, the NYSE, and we consult with the company's financial advisor, we establish a reference price. And this reference price is just that. It's just something to refer to. It's not a price at which any shares are being sold, so it's not the IPO price that you typically see. There's nothing being allocated there. But it's simply a price that gives the market a sense of where the book building process the following day is going to start. And actually, much of the need for a reference price really comes from the brokerage systems themselves, where the brokers actually need to start with an input other than zero. So sometimes it's just simply mechanical that it's needed, but I think it's misunderstood that some folks kind of look at this as being a price at which everyone should be looking at in terms of evaluation. So we established this.
Yes, and maybe you're going to get to it right now, but how is it established, or who establishes it? Yeah,
so again, the NYSE, we establish it and we consult with the the financial advisor, but what we do is we look at any private market activity, we look at volume weighted average prices, or what we refer to as the VWAP, and we also look at, in case there's not any trading, that third-party valuation that I had mentioned earlier. And we publicly release that reference price the night before any trading begins. So the next morning, once the market starts at 9:30, that's when the price discovery process begins. It typically, for an IPO, takes some time. For a direct listing, it just takes that much more time. And both Slack and Spotify took about 3 hours apiece. And from our perspective at the New York Stock Exchange, we will take as long as it takes for companies to be able to find the right price at which to open. We want to make sure that companies open at the right price, and then volatility thereafter, we want to be very, very, very thin, and so we'll take the time that's needed in order to open it. The designated market maker, or the DMM, is the one on the floor actually kind of putting that book together. They're working with the financial advisors to bring in order flow, and they're transparently communicating that to the market and looking at where the stock is going to open. Over this 2.5, 3 hours, buyers and sellers adjust their orders for that period of time as the market starts to kind of hone in on the right opening price. So the DMM communicates any changes in the indicated range. This range can move up, it can move down, it can widen, it most likely tightens over time until the right price is met. There are several indications that will happen over a period of time. So, for example, if the reference price happens to be $30, the first indication may be something like 33 to 36, and this is purely hypothetical. And then it will move up or down or tighten from there. And then, because every time you have a new indicated range, more buyers may want to buy, more sellers may want to sell. And so we're getting all of that feedback and incorporating that into what we're seeing in the order book. At some point, those buyers and sellers, that supply and demand, find an equilibrium point, and then we're ready to open the stock, and we do so on the floor of the New York Stock Exchange.
Mm-hmm. And who has chosen the market makers at the company?
Yeah, so there are 5 designated market maker firms at the New York Stock Exchange, and the company has the opportunity to select one of them. And just know that these are different than your typical market makers. So market makers have obligations to quote on exchanges with a certain range, both above and below where that quote is, and that's really their only obligation. Our DMMs are special market makers that have more obligations to facilitate trading, reduce volatility, add liquidity to the marketplace, etc. So there are 5 of them, and typically companies will meet with them and spend a lot of time in having those conversations as to, is this the right DMM to be working with me. So far we have 2 that have been done in the market. Both happen to have been done by Citadel Securities, but companies are encouraged, of course, to speak with multiple market makers, and they do in terms of making their selection. Mm-hmm. What is so important for that DMM on day one is, it's been mentioned a couple of times that there is no stabilization agent in this process. And so the DMM is really, really important, and we think is the reason why the New York Stock Exchange is the best place to get this type of transaction done. They have 2 obligations and 2 key roles in a direct listing. The first is to open the stock at the right price, which involves that whole price discovery process that we spoke about. But the second is they're required to maintain price continuity, and they're required to maintain a reasonable depth of liquidity in the marketplace so that any kind of temporary disparity between supply and demand is minimized. They supply their own capital in order to do this. All the DMMs on the floor of the NYSE have certain capital requirements. And for direct listings, and this is part of that whole interview process, they will talk about how they're going to deploy that capital. And in some cases, they do deploy quite a bit. Given the absence of the stabilization agent, this is just absolutely critical, and this is why, again, we focus on large and complex transactions here at the exchange, and this is just one of those examples where it is really helpful to have a guy out there on the floor that actually is managing all of this in absence of a stabilization agent or underwriter.
Carolyn, we know that the New York Stock Exchange has filed with the SEC a proposed rule change to allow companies to actually raise primary capital through a direct listing. Could you comment for a minute or two on that?
Yeah, absolutely. I mean, we've heard a little bit already on the call today that one of the disadvantages is that of a direct listing is that you can't raise primary capital, and there's been a lot of interest from companies and investors in looking into potentially doing that. And so what we did late last year was we filed with the SEC to allow for two things. One is that primary capital raise, and then second is to allow for a broader group of companies to be able to take advantage of the direct listing. And that was in the form of looking at the qualification standards in terms of numbers of shareholders and float when a company actually lists. We filed late last year, and which is typically the case, by the way. The SEC rejected the filing. Anyone who works closely with the SEC knows that whether it's punctuation or whether it's something more substantive than that, the way that they deal with that is they reject the filing. We very shortly thereafter refiled. And right now, the filing remains out there for public comment, and we're waiting for, and that will be so for the next few months, and we're waiting for a decision from the SEC at that point. So from our perspective, we just wanted to make sure that we got the ball rolling in terms of kind of creating a framework or standards around this concept of being able to raise additional capital. How companies, how advisors, how the market uses that is going to be really up to them, but we thought it was really important to sort of create that starting point and have something for people to start working off of.
Yes, okay, thank you. So we heard from Morgan Stanley about how many direct listings they anticipate before the end of the year. Probably, initially and now with the situation that we're all in. How would you respond to that question? What are you seeing, and how many do you expect before the end of the year?
Well, I don't have CNBC up, but I do understand that the circuit breaker was just tripped this morning. And look, we're in unprecedented territory, right, in terms of what the market is experiencing and the world is experiencing right now. We don't know how long this volatility is going to last, and certainly because of that, the IPO market, companies have been delaying their launch of their road shows, and they're doing so week by week until things become a little bit more clear and more certain. And I think we're going to see the same here on the direct listing side. That said, if everything, if we have an answer to what we're currently going through relatively soon, I think there still could be, a handful, 3 to 4 direct listings this year. But it's really, we're taking it day by day, we're taking it week by week, and we'll see what happens.
Yes, appreciate that. So would just like to know if there are any closing comments or observations from Morgan Stanley.
No, I think this has been fairly comprehensive. I think it's important to remember that this is a product that continues to evolve, and innovation is anticipated as the market, both the buy side and the corporates, start to figure out the product. So, it's ripe for innovation. It's looking for new ideas, and I think it's something that is now being talked about in every boardroom and management team meeting. So, it's something to get smart on, but also to be thoughtful on.
Yeah. Anna, anything more?
Well, I think, yes, I think that obviously once the SEC comments on the NYSE proposal, I think the number of options will only increase for issuers. As we mentioned, while this new direct listing model is attractive and useful to companies that have raised a lot of private capital at attractive valuations, if there were a component that also would allow for some primary issuance, that certainly would change some of the thinking and some of the factors that we talked about today in terms of the candidates and who ought to factor direct listings into their thinking.
Yes. Okay, thank you. Carolyn, the last word is yours if you want it.
Well, I agree with everyone. I mean, we're in the very early stages of direct listings. It's only going to innovate further and get better from here. And then as your question earlier, Phyllis, it's still, I mean, we need more public companies out there, and if this is a way to get them there, that's terrific. There are other methodologies as well. The IPO is not going away. It's worked well for decades. So we love to see more innovation. If anyone has any great ideas, feel free to reach out to us and talk to us about it. We're more than happy to change our listing standards, work with the SEC, work with companies on anything interesting like this going forward.
Good, thank you. So thank you, Carolyn Saki from the New York Stock Exchange, and thank you to Ashley McNeil from Morgan Stanley. Thank you to Anna Pinedo from Mayer Brown, and thank you all for attending this webinar this morning. Have a good day and stay healthy. Bye-bye.